Hello dear students, Namaskar. This is CA from KK Commerce Academy, the destination where success begins. Students, class 12th ISC board. If you opted commerce stream, definitely accountancy is one of the interesting subjects. So we are going to start accountancy subject, and this is session number 2. So already lecture number 1, which is already available on this YouTube channel in this playlist only. So definitely, if you miss this, go through this, and if you already watch this, then definitely you can connect to this session. But I guarantee that even if you come directly to the session, you will not go to session number 1 immediately, right? So for you, we are going to revise the first session now. So students, basically tell me, I'll just tell my some information about myself. So I'm chartered accountant. I completed chartered accountancy and master of commerce in 2016, and from last 10 years, I'm in teaching field only. So since teaching is my passion, I am already teaching to thousands of students of multiple boards, say Maharashtra State Board, CBSE, ISC, IGCSE board, and our students are widely spread throughout the world globally. So like India, Australia, Canada, Oman, and Malaysia, we already have students in these multiple countries. So if you are thinking to join KKCA as a career option, or we can say as a career partner, definitely you are at the right place. You are in the safe hands where you will get the quality education, definitely. And one of the biggest plus point is, even if you attend live sessions, or possibility number 2, if you miss any of the live session, you will get recording in both the cases. You will get the recording of every lecture, which is valid till the end of the exam. Okay, so you can watch these sessions either on Android phone, or if you have iPhone, so you can watch on that also. And if you want to see the lectures on laptop, you will have the access on laptop view also. So students, this is one-stop solution for your commerce journey. So now we are moving to the next part, but before starting the next part, I will just go through the previous sessions recap. So students, we started with the accounting of partnership firm, and the first topic is fundamental of partnership firm. Okay, so in fundamentals, we just complete few part yesterday. So first of all, we gone through the definition of partnership, where section 4 Indian Partnership Act 1932 state that partnership is the relation between persons who have agreed to share of the profit of business carried on by all, or any of them acting for all. So students, when 2 or more person coming together, they are planning to do the business, they are doing business, or profession also. Okay, profession also included in this word business. So because, for example, few people come together and they form a teaching institute, for example, coaching institute. Okay, so this is not a business, this is a profession. So a doctor, lawyer, teacher, architect, interior, these all are profession. So professional person also can form a partnership. Okay, so this is carried on by all. That means all partner can actively manage the business, or any of them acting for all. That means it is not necessary that all partners should be actively involved in the management of the business. Some partner may be actively involved, and some partners are sleeping partners, they are taking the rest, still they are partners. Okay, so it is also valid partnership. Students, there are 2 point of view, legal and accounting point of view. Always remember that from legal point of view, Indian Partnership Firm, or we can say simply partnership firm, and partners, both are one and the same, they are not separate. But when it comes to accounting, in accounting there is one concept, business entity concept, and business entity concept says partnership firm is different and partners are different. Okay, now basically features, first feature is 2 or more partners, so minimum 2 and maximum 50 partners can be there in the partnership firm. Minors cannot be added in the business as a partner. Okay, but minor can added in the business as a profit sharing only. Okay, so for example, if there is loss in the business, or if there is any liability, so you cannot say to minor that you have to bring additional money from your private estate. But if there is just a part of sharing of the profit, you can add the minor in the business for sharing the profit. Okay, next, agreement. So Indian Partnership Act says oral agreement or written agreement, both are valid, no issues. There is not compulsion, or there is no any mandatory requirement that partnership should be written or registered. Nothing is mentioned. It is not compulsory in India. Only in state of Maharashtra, basically, registration is compulsory. Now back to the point. It is suggested that written agreement should be there. It is suggested, but not mandatory. Okay. Next, students, profit motive. Of course, if you are doing the business in partnership firm, we are doing business, and business motive is to earn profit. So whatever profit we are earning, we will share this to each all the partners in profit sharing ratio. And if multiple person come together and we are doing business and our intention is not to earn profit, it is not partnership firm. Okay. Next, last is unlimited liability. Students, in partnership firm, one of the disadvantage of partnership firm is that liability is unlimited. So do remember that partners liability is joint, several, and unlimited. So what is meant by joint, several, and unlimited? So I think in yesterday's session we already see the example. See, for example, business, we sold all the assets of the business and we realize only 60 lakh rupees, but total liability on business is 1 crore. So there is a shortfall of 40 lakh rupees. So this 40 lakh rupees shortfall is to be bear or borne by all the partners in profit sharing ratio. So considering there are 4 partners, so every partner is expected to bring 10 lakh rupees in equal profit sharing ratio. We are assuming this, that profit sharing ratio is equal. Okay. So in case any of the partner became insolvent, that is bankrupt. So suppose we just take the example that A became insolvent, he is able to bring only 1 lakh rupees in the business. So there is a shortfall of 9 lakh rupees. So this deficiency, or that is this shortfall, is to be borne by all other solvent partners. Okay. So other partners, that is B, C and D, they have to bring their own 10 lakh rupees plus 3 lakh rupees additionally, which is deficiency of insolvent partner. So that's why the liability of the partner is joint, that is everyone have to bring, then several, that if any partner became insolvent, other partner have to fill up that deficiency, that is several. And last, unlimited, that means they have to sell, partners may need to sell their personal properties, personal assets to pay business liabilities, that is unlimited liability. Okay. Now, right and liabilities of partners. So first right is, of course, every partner have the right to share profit or loss of the business. They can participate in the conduct of the business, and of course, if any matter which is related to partnership, they can consult, they can give consult. Of course, if they want to check, if any partner want to check books of accounts, they can check this. If partnership business is planning to add new partner, so every partner has the right to disallow admission of any new partner if they are not willing to join them, so they can disallow new partner. Then joint ownership of partnership property. So whatever property we bought in partnership business, so it is owned jointly by all the partners. And if any of the partner give loan to partnership firm, then he will get interest of 6% per annum, even if nothing is mentioned in the partnership deed. And next, he will get indemnified for expenses. So if any of the partner make expenses from his own pocket for business, so he will get reimbursement, that is indemnified. Okay. And next, last, retire after giving proper notice. Of course, every partner can retire on his own wish, but the only thing is he has to give proper notice regarding his retirement. Okay. Next, liabilities of partner. So these are rights, now these are liabilities. So liabilities of partner is, they must not carry competing business. If they are in partnership business, they are doing some business, it's competing business, it not should be the business of any of the partner. Okay. Next, profit earned using firm's property or money must be paid to the firm. Students, if any of the partner earn any profit privately by using firm's property, then that profit is to be paid, that money must to be paid to the firm by partners. Okay. So every partner is jointly and severally an unlimited liability, as already we saw, and bound by the act of other partners. So if any of the partner take any decision, other partner have to follow this decision. Okay. So now next part is partnership deed. So students, this was the recap, almost 9 minutes completed for starting the session, and in this we already gone through all the part which we studied in the previous session only. Now we are starting the next part. So now pay full attention. If you have any doubt, if you are live in the session, you can ask immediately. If you are watching the recordings, then you can just give a comment and we'll definitely try to reply you as fast as possible. Okay. Now partnership deed. So students, see what they are mentioning in the partnership deed. Partnership deed, which is also called as articles of partnership, is a written document containing all terms and conditions agreed upon by partners. So students, partnership deed is a written document. Sir, you told earlier that It is not mandatory to have a written agreement. Oral agreement is also valid. Yes, brother. I am saying the same thing again. A written agreement is also oral agreement is also valid. But when this is written on the pen paper, it becomes a partnership deed. Okay, so partnership deed is a written document in which there are all terms and conditions related to partners is mentioned. So all terms and conditions, for example, there are two partners. So how much capital to be bring by each of the partner, how much is the interest on capital, how much is the rate for interest on drawings, then what are the rules for dissolution of the business. So any terms and condition mentioned in this related to partnership firm, of course. Though not legally compulsory, it is highly advisable. So I just tell to you that it is not mandatory, it is not compulsory at all to have the registered partnership deed, but it is suggested, it is definitely suggested that having a partnership deed legal or in written form is always suggested, because in case there is a dispute, in case there are disputes in the partners, so in such a case written agreement is also of course definitely very big proof or valid evidence to solve this dispute. Okay, so students, first is regulate rights. So partnership deed clearly mention that duties and rights and liabilities of each partner, which is mentioned in the partnership deed, so there is no confusion about rights and liabilities. Then it avoids the disputes, so all the terms are laid down in advance, preventing misunderstanding. So definitely there is a less scope for misunderstanding if everything is written. So in case of dispute, you just can refer the partnership deed, see what is written here. So there is no dispute on this. And last, easy settlement. Any dispute can be resolved by referring to the deed. So definitely if dispute is go to the arbitrator or say a court, so definitely in the court of law, when there is a judge have to take the decision, so by referring to partnership deed, judge can take decision immediately, very easily. Okay, so students, what are exactly contents of partnership deed? So which things are added in partnership deed? So first point which is added in partnership deed is identity, that is name and address of partner, date and duration. So we have to mention the name of each partner, then addresses, personal address of each partner, and of course date and duration. Sir, what is date and duration? We of course we understand the first point, that we have to write the name of the partners and address, but what is date and duration? Students, sometimes it happens that partnership is made for a specific period. Say for example, we are making the partnership for next 2 years only. After 2 years, partnership firm will dissolve, it has the expiry date. Okay, so if we are making the partnership for a specific time period, we have to mention this in our partnership deed duration. Okay, sir, suppose we are planning to make the partnership business, okay, but we don't want any expiry date. That means we are making the partnership for long life. So what can we do? Then there is no need to mention the duration, of course. If duration is not mentioned, that means it is partnership at will. That means they can continue the partnership as per their will, and of course they can end the partnership as per their will, of course, on the will of the partners. Okay, next point which should be there in partnership deed is business. What business they are actually going to do, this is the most important point. So if 2 or more person come together to do a business, but what business, which business, what is the name of the business? So here in partnership deed you have to mention which type of business they are going to do, and even the name of the business. Okay, even if there is a partnership firm, normally the business has different name from partners. Okay, an accounting period also. So normally in India, accounting period is standardized, which is 1st April to 31st of March. So even though it is not mentioned, so it is considered that 1st April to 31st March is the year. Actually this point is old now, because earlier there was option for the business, they can select their own financial year either from 1st January to 31st December, or as per the Indian pattern, that is 1st of April to 31st March. But now it is mandatory, it is compulsory for every organization, every company, every partnership firm, that you have to follow only Indian financial year, that is 1st April to 31st of March. Okay, next is capital. Students, in capital you have to mention first thing contributions. That means how much capital to be bring by partners. Say for example 10 lakh rupees capital to be bring by all the partners, so you have to mention that. Then interest on capital. So if additional capital is bring by partners, or if there is a loan is given by partners, so you have to mention the interest. And also drawings. So drawings means the amount which is withdrawn for the personal purpose by the partners. So if any partner is withdrawing the money, excessive money, so this may be a wrong practice that any of the partner is bringing money as per their convenience at their home. But students, just a second. Okay, so students, as I was saying, interest on drawings. So suppose if partner is withdrawing the money for personal purpose, so interest should be charged. It should be mentioned in the business, the partnership deed. Next, partnership deed contain is profit sharing ratio. This is one of the important part, since we are doing the business for sharing the profit, of course. So profit sharing ratio must be there. Then salaries. So students, if any of the partner is a working partner, then in such a situation, salary should be given to the partner. Okay, say considering the example, one partner is A and another partner is B. A is an active partner who is actively involved in the business. He is taking all the efforts, and B is doing nothing. He just invested the money. So in such a situation, if we are deciding the profit sharing ratios to be 50-50, that is 1:1. So in such a situation, it is not justice to partner A. So to give justice to him or motivate him to work more, we can give salary to the partner. So it should be mentioned in the partnership deed. And last is goodwill. So if there is any method for calculation of goodwill, division of goodwill, it should be also mentioned in partnership deed. Next is governance. So governance means rules and regulations basically related to auditing. If if they decided to admit the new partner, then what are the rules or procedure to be followed? If there is dispute in the partnership business, then how to solve these disputes, by going maybe arbitrator or court of law or any mediator. So whatever option they select. So these all things are should be mentioned in the partnership deed. So if you see this clearly, you will understand this majority of the issues solved here. Majority misunderstanding got solved here only. Okay. Now, rules in the absence of partnership deed. So students, we already see that partnership deed is written document, but here also mentioned that it is not legally compulsory. That means every business is not making the partnership deed, right? So since every business is not making partnership deed, then there are a business, either say option number one, either they didn't make partnership deed. Okay, probability number one. Probability number two, they made the partnership deed, but they left out few points. Suppose by mistake they forgot to write interest on capital, or the interest on drawings they didn't mention these, or suppose profit sharing ratio is not mentioned at all. So in such a situation, what should we do? So in such a situation, we have to follow Indian Partnership Act 1932. So let's see what exactly Act says. Okay, so before watching this, let me clear you. Indian Partnership Act says, first of all, whatever happens, follow to partnership deed. Partnership deed is of course, at prime. Okay, so if you decided that profit sharing ratio is suppose 90% to one partner, 10% to another partner. If partnership deed say so, it is valid, no issues at all. Okay, so but in the absence of information, we have to come to this point. So if there is no partnership deed, or it is silent on a point, the following provision of the Indian Partnership Act 1932 applies. So point number one, profit sharing ratio. Is nothing is mentioned in the question, then profit sharing ratio should be taken as a equal. So equal sharing is there irrespective of capital contribution. Doesn't matter how much capital contributed by whom, but profit sharing ratio must be equal if nothing is mentioned in the question or nothing is mentioned in the partnership deed. Okay. Next point, interest on capital. Suppose partnership deed is silent about interest on capital, then interest is not to be paid. No interest on capital. Okay, no interest on capital if partnership deed is silent. Next point, interest on drawings. So if interest on drawings is not given, again no interest to be charged on drawings in the absence of information. Next and last, salary and commission. Again, partnership deed is silent So no partner can claim salary or commission, even though he's a working partner. He's taking efforts. He's doing work for 15 hours per day. Doesn't matter, man. If nothing is mentioned in the partnership deed, you will not get the salary. Okay. Next, interest on partner's loan. So students, if any of the partner give loan to the partnership firm, then if partnership deed is silent, then interest is to be paid 6% per annum. Okay, even there are loss. So students, this is very important line. It is payable even if there are losses. So in normal circumstances, suppose if we have to give salary to partner, if business have to pay interest on capital, in all the situations it should be paid. All the points, interest on capital, salary, commission, these things to be paid to partners only if business is in profit. But do remember, if partner is giving loan to the partnership firm, then even though there is a loss in the business, we have to pay. That means business, that is partnership firm, have to pay 6% interest to partner. Okay. And next, admission of new partner. So students, do remember, new partner can be admitted with the consent of all existing partners. So for example, there are 20 partners and they are just planning to add 21st of partner. If all existing 20 partners say yes, they give the confirmation, then only you can add 21st of partner in the business. Okay. So these all are the rules applicable when the partnership, there is no partnership deed or partnership deed is silent. Okay. So students, I would like to give some more information about our institute in Hindi. So let's see.
कॉलेज के बाद जॉब के बाद थकान और पढ़ाई का क्या? लेकिन अब पढ़ाई होगी जब आप चाहो. इंट्रोड्यूसिंग के कॉमर्स अकेडमीज रिकॉर्डेड लेक्चर्स एनी टाइम एनीवेयर. चाहे आप वर्किंग प्रोफेशनल हो, चाहे आप स्टूडेंट हो, हाउसवाइफ या बिजनेसमैन, घर पर हो या सफर में हो, जहां इंटरनेट वहां आपका साथी KKCA. KKCA ऐप में आपको फीचर्स मिलते हैं जैसे कि वीडियोस डाउनलोड करें, स्पीड अपने अकॉर्डिंगली एडजस्ट करें और इसके साथ ही आपको डाउट सेशन और नोट्स भी मिलेंगे. KKCA प्रोवाइड्स कोर्सेज लाइक 11-12 के सभी बोर्ड्स, HSC, CBSE, ISC, BCom, BBA, MCom, MBA, CA, CS, CMA फाउंडेशन एंड सारे गवर्नमेंट कॉम्पिटिटिव एग्जाम्स लाइक ऑडिटर एंड अकाउंटेंट. अब हर किसी की पढ़ाई अब उसके पॉकेट में. सो एनरोल नाउ. Download the KK Commerce Academy application and start your journey now.
Yes, so definitely I assure you, if you're planning to start your journey with KKCA, you are in the safe hands and your future is definitely bright. Here you will get quality education. I'm not saying it is cheap, of course. You have to pay the proper fees, reasonable fees, or affordable fees as much as possible, but there is no compromise in the quality. And students, since you're a student of ISC board, if you want to learn either in Hindi, suppose English is comfortable for you, Hindi plus English, so you can learn in that format also. If you want to learn completely English, of course you are attending the session only. And if you want to learn either in one-on-one basis or group classes, both options are available to you. And if you want to see only the recordings, neither you don't want any of the lecture in live session, that option is also available in KKC app. Okay. So just you have to remember, note down our number. I'm just writing number here so that you can just write this with me. 8483822271. Okay. Another one, 9145669911. So you can use first number if you want to call our WhatsApp, and second number is on just call for call. So these are the numbers where you can connect us, and definitely our team is there for you to guide for proper future guidance. Okay. Now, profit and loss appropriation. So students, profit and loss appropriation account shows how the net profit is distributed among the partners. It is prepared after the profit and loss account and is an extension of it. Students, this account is new for us. So in class 11th, profit and loss appropriation account was not there. Profit and loss account was there only. So in this question, or when we are going to solve final account of partnership firm, or we can say partners capital account. So in this situation, we have to understand first what is profit and loss account. Then after profit and loss account, its extension, second part is profit and loss appropriation account, which is extension of profit and loss only, but it is different, it is prepared differently, and of course different accounts or different amounts are entered here. Then adjustments, of course in question there are few adjustments are given, so we have to consider that adjustments also, and after considering this we can prepare partners capital account. Okay, so students, item like interest on capital, salary to partner, commission to partner, they are appropriations. These are debited to profit and loss appropriation account, and it is not charged against profit. Students, I remember, I'm just revising this line. What is given here? Interest on capital, commission to partner, salary to partner, these things which we are paying to partner, this should be debited to profit and loss appropriation account. This is the appropriation of profit, and this is not the charge against profit. So what exactly it means? So just see in detail. There are two accounts basically, profit and loss and profit and loss appropriation account. Okay, so the first point of difference is after trading account. Of course, first of all we have to start with the trading account. After trading account we have to prepare a profit and loss account. Okay, so step number 1, trading account. Step number 2, profit and loss account. Step number 2. But where of course in trading account we will come to know about the gross profit, and this gross profit is transferred to profit and loss account. Okay, but after profit and loss account, the next step, that is third account, is profit and loss appropriation account. Okay, it starts with the net profit. Always remember, since we already see, I'm just showing you this, we have to start with trading account. Okay, then next is profit and loss account, and then profit and loss appropriation account. So when trading, you close the trading account, of course we have to take total of both the sides, and normally in 99% cases, of course, credit side is larger, so you will get the balancing figure in debit, and where you have to name it as gross profit. This is gross profit. Since this gross profit is in debit here, so we have to transfer this to credit side in profit and loss account by gross profit carried down brought down, sorry, here it is CD, that is carried down, and here it is BD, brought down. So this is the gross profit, this is the starting point for profit and loss account. Then we have to close profit and loss account too. So while closing the profit and loss account, of course we have to take the total of both the sides, and after taking both total of both the sides, we have to reduce the smaller total from the larger total, of course. And in the, again, 99% cases, there is a probability that balancing figure is in debit. It is known as net profit carried down. Sir, you are saying that in 99% cases balancing figure is in debit, and if it happens that the situation of 1%, that debit side is larger and balancing figure is in credit, then what should we do? Then we have to name it as net loss. Simple. If expenses are more, income is less, then it is a net loss. Okay, now this net profit carried down, this is in debit side, so always remember that item which is in debit side, we have to transfer this to credit side, and in profit and loss appropriation account we have to start with that net profit. We have to start with net profit. Net profit brought down. This is the starting point for profit and loss appropriation account. Okay, now I hope you understand first point clearly. See, after trading account, it starts with the gross profit. This is profit and loss, and when it comes to profit and loss appropriation account, it is after profit and loss account, and it starts with the net profit. Okay, now objective. So why we are preparing the profit and loss account? To find the profit, of course, either net profit or net loss. We have to calculate this, ascertain this. So for that purpose, we have to prepare profit and loss account. Done. And about profit and loss appropriation, so it is just for distribution of net profit, whatever net profit we are earning, and how to distribute this net profit to partners. So this is profit and loss appropriation. Done. Next, balance. So in profit and loss account, no opening or closing balance is there. There is no opening closing balance, to balance brought down, carried down, nothing is given here. Okay, but profit and loss appropriation account may have opening closing balance, may have. It is not necessary, but it may have balances. Okay, but it is for sure that profit and loss account will now never have any balance. Next, student, the most important line, which I'll explain you in detail in the next slide also. So in profit and loss account, we have these are the charges against profit. So whatever items we are writing in the debit side of profit and loss account, that is expenses, these are charged against profit. Okay, but when we are writing the debit side of profit and loss appropriation account, these are appropriations of profit. These are not charges against profit. These are appropriation of profit. We are already on the profit, but these are just we can say division of profit, or these are related to profit part only. This is division. Okay, and if matching principle in profit and loss account, of course matching principle is follow, because it is for the year ended 31st March, so we have to match the expenses and income. That's why we already added outstanding expenses, that is accrued expenses, or if there is any prepaid expenses, then we have to reduce this. This is just because we are following the matching principles. Okay, but this matching principle is not applicable when it comes to profit and loss appropriation account. It is not followed. Okay, now students, I just use two words, which is charge against profit and appropriation out of profit. So let's deep dive in that part also. So let's see. Students, first is charge against profit. So students, it is deducted while calculating the net profit. In profit and loss account, we are of course charging all the expenses in debit side. That means we are deducting these expenses while calculating the net profit. And these are of course recorded in profit and loss account. It must be made even if there is a loss. There is no any challenge. Even if business is in loss, you have to charge all the expenses in debit side of profit and loss account. Okay, say for example, interest on partner's loan to the firm. I just tell this point just before 5-10 minutes, I think. Where it is? Yes, here it is. Interest on partner's loan. It is payable even if there are losses. Even if there are losses. Okay, so it doesn't matter if business is in profit or loss, we have to charge the expenses in debit side of profit and loss account. Okay, so rent paid to partner, interest paid to partner, interest on loan paid to partner. So these are charges against profit. Okay, but when it comes to appropriation out of profit, that is distribution of net profit. It is already a net profit we earn, and now these are distributed among the partners. So it is recorded in profit and loss appropriation account, which is made only when there is a profit. Students, in case suppose we draw profit and loss account, and in the end of the profit and loss account, we come to the conclusion that there is a net loss in the business. If there is a net loss, then there is no need to prepare profit and loss appropriation account, because profit and loss appropriation is the division of profit, distribution of profit. If there is no profit, what you will distribute, man? There is no requirement to prepare profit and loss appropriation account at all if there are no profit. Okay, so in profit and loss account, in profit and loss appropriation account, we have to show adjustment related to partners, that is interest on capital, salary paid to partner, commission paid to partner, interest on drawings charged by partners, then part of the profit which is distributed to reserves, transferred to reserves. So this forms part of profit and loss appropriation account. Okay, so do remember, net profit is the profit as per profit and loss account. Net profit is the profit which is as per profit and loss account, but divisible profit is profit as per profit and loss appropriation account, which is after all the appropriations. Okay, so there are two. First concept is gross profit, which comes to trading account. Then next is net profit, which comes in profit and loss account. And now new concept is divisible profit, which is the conclusion of profit and loss appropriation account after transferring all appropriations to partners also. Okay. Now, there are two methods of preparing the partner's capital. One is fixed and another is fluctuating capital accounts. So, we'll just go through this one by one. In today's session, we are not going to solve numerical question. By tomorrow, that is by next session, we are going to solve the numerical questions. But today's target is just to cover the theoretical part. And of course, this theoretical part is the base for solving the numerical questions only. Okay, so we are just focusing on strengthening this base today's session. So let's see, we'll see the two methods of capital accounts. So let's see. Students, first method is fixed capital method. So in fixed capital method, the name itself suggests that capital should be fixed. The capital balance which is brought by partners, of course, this should be fixed and it should not be changed after every year. So how is it possible, man? In business, there are multiple transactions, so capital is changes, but to keep it same, we have to prepare two accounts. One is partner's capital account and one is partner's current account. Okay, since we have to keep the partner's capital constant, so we will record this in partner's capital account, and all of the transactions so related to drawings, interest, salary, loss, share of the profit, share of the loss, whatever we are doing, all transactions to be recorded in current account. Okay, and here when it comes to fluctuating capital method, the name itself suggests that capital is fluctuate every year. So since this is fluctuations are allowed, then we have to prepare only a single account whose name is partner's capital account. So we have to record everything here only, everything recorded here. So it is capital account. So even it is opening balances, then drawings, then interest, then salary, share of the profit, share of the loss. So everything is to be recorded in this partner's capital account only. This capital changes every year. That's why it is known as fluctuating capital method basically. Okay. So these are the two methods of preparing a partner's capital account. Okay. Fixed capital method and fluctuating capital method. Done. Next. Let's see the format. We just go through the rough format. How we draw exactly what are the components in these accounts. Then we'll solve the questions in next session. Now, under fixed capital method, each partner maintains two accounts. One is capital account, which is rarely changes, and current account, which always changes, of course, because there are n number of transactions. So in fixed capital method, see, capital account, we show both the sides here. If 2 is written here, that means these are debited, and if there is a buy, that means these are credited. Okay. Now, if we discuss about partner's capital account in fixed capital method, okay, so of course opening capital should be credited, that is balance brought down, sorry, in credit side there should be a balance brought down. Okay, and if any additional capital is bring by the partners, then it should also be credited. So this basically in partners capital account there are only two transactions, only two. Which are they? First, opening balances, another if additional capital bring in the business. So these two items only credited in the partners capital account. And in debit side, if there is a drawing, but it should be permanent withdrawal, that means this amount is withdrawn from the business forever. That means this is not a temporary drawings. So normally partners make drawings just for spending small expenses, for bearing their rent or personal expenses. But here, if partner is withdrawing the money permanently from the business, forever from the business, then it should be debited. Then capital should be reduced. Okay. And in the end, of course, we have to calculate balance carried down. That is closing balance in the partner's capital account. So students, this account should be debited and credited in partner's capital account. Done. And when it comes to current account, because this is fixed capital method, so in fixed capital method we have to prepare two things: partner's capital account and partner's current account. So current account have multiple transactions now. So let's see. So students, simple rule, just remember the simple rule: if partner's capital increases, then it should be credited, and if partner capital decreases, then it should be debited. Okay. So students, to drawings, if capital is withdrawn for personal use, then definitely capital balance will decrease. So in such a situation, we have to give debit, and again remember the simple formula or trick: D for drawings, D for debit. Even this rule is applicable for interest on drawings also: D for drawings, D for debit. Okay. And in case there is a losses in the business, then in such a situation it should be debited. Current account should be debited. So there are only three situations. One is drawing, another is interest on drawings, and last one is share of loss. So only in these three situations, partner's current account should be debited. In all other situations, it should be credited, whether it is interest on capital, salary given to partner, commission paid to partner, share of the profit distributed to partner. In all the situations, it should be credited. Only in three situations, it should be debited: drawings, interest on drawings, and loss in the partnership firm. Okay. Now, fixed capital account can never show a negative balance. Students, always remember, fixed capital account is always show positive balance only, always. So it should be credit balance only. But current account, there is a possibility in current account opening balance may be debit balance or may be credit balance. We can't say exactly. It depends on case to case, of course, question to question. In majority cases, 99% cases, even though when it comes to current account, opening balance is credit only. But there is a probability that 1% cases, there may be a debit balance, or that is negative balance in current account. Okay. And fluctuating capital method. So fluctuating capital method, there is only one account per partner is maintained. So in the absence of information, always use this method. This is also important point to remember. If nothing is given in the question, nothing is mentioned about the type of the method, then we have to use always fluctuating capital method. So in fluctuating capital method, see how capital account draw exactly. So this is left side is of course debit, right side is always credit. So students, see D for drawings, D for debit, and even interest on drawings also got debit. Drawings and interest on drawings debited, and if there is a loss, if there is a share of the loss, it should be credited. Done. So in short, debit side is almost same. Debit side is almost same, even though it is current account or capital account. Okay, but in credit side, the first is opening balance brought down. So students, if there is any opening balance in the partner's capital account, it should be credited. Okay, then suppose partner being additional capital, our capital will increase, so it has to be credited. If partnership firm is giving interest on capital, again capital is going to increase, so it should be credited. If partnership firm is paying salary or commission to partner, again credited. And in case there is a share of the profit, it also has to be credited in capital account. Okay, so always remember, fluctuating capital account can show a negative balance, but again in majority cases it should be credit balance only. Opening balance is credited. Okay, so calculation of interest and interest on capital, interest on drawing, and so on things. So definitely we'll go through this in detail in the further sessions. So students, if you are new on the channel, then remember just to subscribe the channel, like this video, and share this video with all your friends who are in class 12 the ISC board. Okay, and don't forget to subscribe and press on the bell icon so that you will get the notification of the next sessions as soon as the session start, and you can join in the live session itself. Okay, so student, that's it for the session. So I hope you remember to download our app from Play Store if you are using Android, and from App Store if you are using Apple device. So see you in the next session. By that time, happy learning with KKCA. Bye bye.